Hello, everyone, and welcome to Health Reform Beyond the Basics. We know you all have a lot going on right now, so we want to really thank you for taking the time to join us today. Most of you have been a part of this Beyond the Basics project for years, but for those of you who are new, I'm Hallie Cloud, and this is a project of the Center on Budget and Policy Priorities. It is designed to provide training and resources that help explain health coverage options available through the health insurance marketplace and Medicaid. It is aimed at healthcare assisters, advocates, state and local officials, and others who help people get and keep their health coverage. We at the Center on Budget are a policy nonprofit in DC. And as a reminder, this series is intended for those working on the implementation of health reform and is not intended for press purposes. Today's webinar, the first in a four-part series on core elements of eligibility and enrollment, will be on eligibility rules for the premium tax credit, including how offers of employer-sponsored coverage can affect eligibility, as well as how the credit is calculated. And we'll also go into a little bit about how you reconcile the premium tax credit at tax time. Now, with that, I'm going to turn it over to our presenter today. Tara Straw is a senior policy analyst here at the center, and she is going to be your presenter today. Take it away, Tara.
Thanks, Hallie. We're going to talk about premium tax credits today. We're going to look at three different aspects of premium tax credits. We're going to consider eligibility. We're going to look at the calculation of the tax credits, and we're going to talk a little bit about reconciliation on the tax return. Open enrollment, as you know, will start on November 1st and go until December 15th. State-based marketplaces are able to extend their open enrollment period with a supplemental special enrollment period. And you can see these are the states that we know now are going to do that. And you can see that California is the only one that's going to start on October 15th. Some states we haven't heard anything about. It might be because they've decided not to extend. Maryland, for instance, has already announced that it won't extend open enrollment, as well as Washington. So we will update the slide in the slide deck that we post online, and so you will be able to get that information here, and of course you'll be able to get that from your state-based marketplace. This is just an overview of how these public programs fit together. So as you know, Medicaid has broader coverage for children, pregnant women, and in expansion states, coverage for adults and for childless adults and parents goes up to 138% of the federal poverty line. You can see that for states that have not expanded coverage, coverage is unavailable to many people, including many parents and childless adults. And they're in the coverage gap where right now they don't have any assistance available to them. Above those levels, you can see eligibility for the premium tax credit, and that goes up to 400% of the federal poverty line. Above that amount, there's no financial help available. Let's take a deeper dive into premium tax credit eligibility. As you all know, the premium tax credit is assistance with the cost of coverage for people purchasing coverage in the health insurance marketplaces. And it can be taken at two different times. It can be taken in advance, where the Treasury sends an advance payment directly to the insurer, or it can be taken at tax time, where the enrollee pays the full premium and then on the tax return gets that money back in the form of a refund. There are three big buckets that we're going to talk about in premium tax credit eligibility. These three big requirements that take up a lot of our time and effort are income. You have to have income between 100% and 400% of the federal poverty line. Some exceptions apply. You have to be ineligible for other MEC, such as Medicaid or employer coverage. Some exceptions apply. And you have to have an eligible filing status. So you can't be married filing separately, you can't be a tax dependent, and again, some exceptions apply. And we're going to focus on those exceptions. Reminder that there are some other requirements. We're not going to talk in depth about them today. One requirement is that you have to be a U.S. citizen or have a status that's considered lawfully present. We'll really dive into that in a separate webinar on immigration-related issues with the marketplace and Medicaid. You also cannot be incarcerated, and you need to be a resident of the service area of the marketplace. If you move, you have to change your residency and possibly your plan. So let's start our exploration of the income requirements. So I guess that we're focusing on the exceptions. The exception to the lower end requirement that someone has to have income above the poverty limit is that lawfully present individuals with income under the poverty line are eligible for PTC if they are ineligible for Medicaid because of their immigration status. So that means that someone who is a lawfully present individual who meets the immigration status requirements that are established by the marketplace will be able to enroll and get premium tax credits even if their income is, say, at 50% of the poverty line. Another common question that we get and something that comes up is if someone projects income above the poverty line and receives APTC, but then at the end of the year they actually have income that goes below the poverty line, they are protected by a safe harbor. But the new wrinkle for that is that if someone attests on the application that they have income above the poverty line, but then tax data in the verification process says otherwise, the applicant is going to be asked to verify their income projection. This verification is going to look like the other verifications that people need to submit for the marketplace when there's a data inconsistency between what their application says and what the most current information that the marketplace has. So that process is going to be the same, but this is a new population that will have to go through that process. And as far as exceptions to the upper limit, the 400% FPL limit, there are none. And that means that if a taxpayer's income is 401% of FPL or higher, the entire credit has to be repaid. And this can be a really harsh reality for some people that are at the upper end of the scale. Now, who might that affect? People who are younger are less likely to have this as an issue because in general, their premiums are going to be lower, already going to be phasing out at the upper limit of income. And we'll talk more about that in the credit calculation section. The people who are at risk of having large repayments are people who are at the upper end of the age band because they are still getting significant premium tax credits at that income level, and so they will need to pay back a larger amount than maybe someone who is younger. Another requirement to get a premium tax credit is that a person must be ineligible for other forms of minimum essential coverage, or MEC. We're looking not just at eligibility, but just having an offer of qualifying MEC is going to bar someone from taking a premium tax credit, even if they didn't take the insurance. In general, we're going to look at two big principles that you can consider when you're looking at whether insurance bars eligibility for premium tax credits. In general, insurance needs to be considered affordable, and in particular, this is relevant for employer-sponsored coverage. Offers of employer-sponsored coverage that cost under a certain percentage of household income will bar eligibility for PTC. And we also consider how comprehensive the insurance is. So an offer of coverage that has comprehensive benefits generally bars eligibility for the premium tax credit. This includes most types of public coverage and most types of employer coverage that meets a minimum value standard. And we have this great chart there's a link at the bottom of your screen that goes through all the different types of MEC that you can imagine and says whether it counts or whether it disqualifies someone from receiving premium tax credit. So definitely check out that tool. So we're going to look at a couple of different categories of MEC and talk about whether these are offers of coverage that disqualify someone from premium tax credit eligibility. First, we're going to take a look at government-sponsored coverage options. Most of these coverage options have comprehensive benefits. So most people that you'll see, if they are in one of these programs, they'll be in Medicare Part A, Medicare Advantage, Medicaid, CHIP. Those are the big categories where the bulk of the people are getting coverage. Now, there are some limited benefit categories where someone can be eligible for that insurance and still be eligible for a premium tax credit. So an example would be Medicaid Family Planning Services. It's a narrow, limited benefit program. And so that kind of offer is not going to disqualify someone from getting insurance in the marketplace with the help of a premium tax credit. And I'll just note that we have on the list here voluntary Medicare. That is Medicare that people need to pay a full premium for if they haven't contributed enough or worked enough quarters to qualify for premium-free Medicare. So that has comprehensive benefits, but for our purposes, it's considered to be unaffordable, or it's on the list to be treated like the limited benefit category. Next, we're going to talk about employer-sponsored insurance and which employer offers disqualify someone from eligibility for the premium tax credit. And we're going to look at two factors. The employer coverage has to meet minimum value, and it has to be considered affordable, and both of those get a little complicated. If insurance doesn't meet these requirements, the employee is eligible for premium tax credits despite the offer of coverage. And the employer offer has to meet both of those requirements. So if they fail on one, then a person might be eligible for premium tax credits, assuming they meet the other criteria. So let's look at minimum value standard. Again, if the employer coverage does not meet minimum value, the employee is going to be eligible for a premium tax credit despite having this offer. Minimum value is set at roughly an actuarial value of less than 60%. And what that means is that you expect the plan to pay for 60% of the cost of coverage for essential health benefits in the plan. You can see what the screen looks like in the Marketplace Healthcare.gov application. They reference the coverage, employer coverage tool. This is something that you can download and take to your HR department to have your employer help you figure out whether the coverage they're offering is minimum essential or is minimum value. We know that some people have had some challenges getting employers to fill this out. This right now, though, is your best option for getting this information from an employer. The second thing that we're going to look at is affordability. In general, an employer plan is going to be considered unaffordable if the contribution for self-only coverage is more than 9.86% of household income. Now note that the employee contribution for self-only coverage will determine affordability for both the employee and other members of the family. We'll look at an example of that. There are some wrinkles to this, which we're not going to talk about today. If your employer offers wellness programs, for instance, you may be using a different premium amount to calculate affordability. There are also some other, quirks of offers that employers may make and how that factors into the what premium you're measuring. If the employee contribution for self-only coverage is considered affordable, then the employee and other members of their family are considered to have an affordable offer of coverage. This is referred to sometimes as the family glitch, and it can leave the family members of employees out of an affordable coverage offer. And again, we'll look at an example of this, but it's pretty common that the employee themselves will have an offer of self-only coverage that's affordable. But when you look at the cost of family coverage, it's much higher than the affordability standard. But even so, that isn't going to give people access to premium tax credits. Now, one exception to keep in mind is if a family member is not on the same tax return as the employee, then the offer of coverage doesn't bar eligibility for premium tax credits. So, for example, if you have let's say that you have a dependent who just graduated from college and they are still, they're under age 26, they are still eligible to be on a parent's plan, but they're not on the same tax return. They're going to file their own tax return. Well, in that case, that offer of employer coverage is not going to bar eligibility for the premium tax credit. So that college graduate can take it or leave it. Let's go through this example. We've got Monica and Roberto. They're married. They have 2 kids. Their household income is $40,000. Monica's employer offers a plan that meets minimum value. The premium for that plan for just her is $150 per month. And for Monica and her family, it's $450 per month. So Monica comes to you and she wants to know what her options are for coverage for herself and her family. Let's break it down. We've got her premium cost at $150 a month. We've got her family cost at $450 a month, and you can see minimum value is met. So does this offer make her ineligible to receive a premium tax credit? For Monica, we're going to look at the cost of her own insurance and whether it is less than 9.86% of household income. And it is. Her share of employee-only coverage is only 4.5% of household income. And that means that Monica is not eligible for a premium tax credit. Now let's consider her family. In this case, because of the family glitch, we're using exactly the same test that we used for Monica. So we're still asking, is Monica's coverage affordable instead of, is the family's coverage affordable? So even though family coverage costs 13.5% of income, the coverage is still considered affordable because employee-only coverage costs less than 9.86% of income. So this means that Monica's family isn't eligible for a premium tax credit. Let's change the scenario just a little bit, and let's say that the offer is not for family coverage, but it's for employee plus kids, and it's at a cost of $350 a month. And there's no spousal coverage, which some employers won't offer spousal coverage. The Firewall test for Monica and her kids will be the same as the previous test. Is the employee-only premium less than 9.86% of income? So even though the cost of insurance for Monica plus the kids is over that amount, the Firewall test is only going to look at that cost of Monica's coverage, and so they're not going to be eligible for a premium tax credit. Now, in this example, though, Roberto doesn't have an offer of coverage because he's not included in Monica's plan options. And so there's no Firewall test for him, and there's no bar to receiving premium tax credit if he's otherwise eligible. There are some additional rules and exceptions for employer-sponsored insurance. If the employer coverage is not affordable or minimum value, but the employee enrolls anyway, then they are not eligible for premium tax credits for those months that they were enrolled. They still have options, though. They can drop that coverage, and they can enroll in a marketplace plan with premium tax credits. But note that dropping that coverage doesn't actually grant them an SEP, a special enrollment period. So they may not want to do that until the open enrollment period, or unless they have some other reason for a special enrollment period. But this alone will not cause a special enrollment period. If a person misses their employer's open enrollment period, that's not good enough. You're still not going to be eligible for a premium tax credit just for missing open enrollment. If there is a waiting period, though, before an employee can enroll, then a person is eligible for a premium tax credit during those months. So if the employer has a 60 or 90-day blockout period, the employee can still have that other source of coverage in the marketplace with premium tax credits. But then they'll have to discontinue the credit and the plan in order to enroll in their employee's plan and their employer's plan. The rules are a little different for COBRA or retiree coverage. That coverage does not bar eligibility for premium tax credits unless you have enrolled. The same logic goes to student health plans. They also don't bar eligibility for premium tax credits unless they're currently enrolled. So you can see some of the logic that goes into the marketplace application, the healthcare.gov application. There's the question about the waiting period. Is Jane, taxpayer, currently in a waiting or probationary period? So the application will take that into consideration. They'll also take into consideration and learn your current work status, if you're no longer working, if you're retired. So these are questions that you will get to via the healthcare.gov application. An example on COBRA, last month Serena left the job where she had health insurance. She has an offer of COBRA now through her former employer, but it's expensive. She chooses not to enroll in COBRA. So the question is, can she qualify for premium tax credits? And the answer is yes. The option to enroll in COBRA, the COBRA offer, does not bar a person from eligibility for a premium tax credit or cost sharing reduction. So she can enroll in marketplace coverage. And she actually has a special enrollment period that's triggered by her loss of employer coverage, or she can wait until the next open enrollment period. But let's reverse this, and let's say that she does enroll in COBRA. Can she drop that coverage and still qualify for a premium tax credit? And the answer is, it depends. The offer of COBRA doesn't bar her eligibility for premium tax credits, but once she's enrolled, she's no longer eligible for PTC. So essentially, you can't double dip. During open enrollment, she can choose to drop her COBRA. She can enroll in marketplace coverage, but outside open enrollment, if she drops her COBRA, that doesn't trigger a special enrollment period, and so Serena would not have access to marketplace coverage. Let's look at the coverage choices that many young adults have. There are some important decisions that some young people make when they have multiple coverage offers. This is Kayla. She's a graduate student and she files her taxes as a single tax filer. She has income that's around 152% of the poverty line. She has a few coverage options. First of all, she is eligible to remain in her dad's employer offer of family coverage. She's not a tax dependent, but she can stay on her parents' insurance until she reaches age 26. So this is a viable option for her. Now note that the offer does not bar eligibility for premium tax credits because Kayla is not on the same return as her dad. So she has a choice here, and just having that offer of employer coverage isn't going to bar her from her other option of having coverage in the marketplace. And we're assuming here that dad's paying the cost, that if he had chosen family coverage with his employer, that the marginal cost of adding Kayla to that is zero. So we're just making that assumption here for Kayla. And it's a good plan. The AV is, actuarial value is 90%. Another option for Kayla is through her school, which has a student health plan. Now, as we said before, the offer of a student health plan does not bar eligibility for a premium tax credit unless she enrolls. So it's an option, but again, she can still choose to forego it in order to get premium tax credits in the marketplace. And of course, option 3 is to just enroll in marketplace coverage, and she can get a plan for $123 a month after her premium tax credit with an actuarial value of 87% after we take into account the cost sharing reduction. So those are Kayla's options, and we don't have to tell her which option to take. It looks like offer one, dad's insurance, is probably the winner, but those are the options that Kayla has on the table. So the third factor that we look closely at in eligibility is having an eligible tax filing status. A person who takes a premium tax credit has to file a tax return, even if they don't have other cause. So even if their income is such that they don't have a tax filing requirement, taking advance payments of the premium tax credit creates a tax filing requirement. They also have to have an eligible tax filing status. A person who is a dependent of another taxpayer is not eligible to take the premium tax credit on their own. Instead, that person needs to be a part of the family unit, and so the taxpayer will have to add their own income and household information that includes the dependent. So the dependent can still be eligible for premium tax credits, but it's on the strength of the taxpayer and the family unit. If a person is married, they have to file a joint return. And that means that they can't have a tax filing status of married filing separately. Now, there are some examples that we're going to talk about that are exceptions to this joint filing requirement. And if one of those exceptions apply, the person can say that they are not married when they're asked that question on the tax or on the marketplace application. Let's look closely at this tax test. This is one of the areas where I know assisters get a little wary because they're not tax professionals and they're not tax volunteers for the most part. And so this seems like a pretty tax-intensive question, but it's important and really consequential for the application. So it's worth having these things in mind. When you have a person who says that they are married, but they're not with their spouse and will not file with their spouse, they would otherwise be in this hole of married filing separately. So these exceptions, if you can run through them, can help get them out of that hole and get them eligible for premium tax credit. First is head of household, and this is an alternative to filing as married filing separately for some married people. And in IRS lingo, a married person will be considered unmarried and eligible to file as head of household if she can answer yes to the following questions. And there are 5 questions. They all have to be yes. Will you file taxes separately from your spouse? Will you live apart from your spouse for the last 6 months of the year? And it has to be the last 6 months with no breaks. It can't be 6 months. Will you pay more than half the cost of keeping up your home? Is yours the main home of your child, stepchild, or foster child for more than half the year? And that can be more than half the year. It can be, it doesn't have to be the last 6 months like the question above. And finally, are you eligible to claim the child as a dependent? And you'll meet this test if you're eligible to claim the child, but the child is instead claimed by a non-custodial parent under the special rules the IRS has for non-custodial parents. So if you answer yes to all of those questions, then the applicant would be considered unmarried and can file as head of household. And you can see that, when they get that simple question, is the taxpayer married? Even though the taxpayer is married, this would qualify them to say, no, they aren't married. There are 2 other exceptions to the joint filing requirement. So a person who is actually married can be considered unmarried. There is an exception for people who have faced domestic abuse. This is people who are married filing separately, but they can meet the joint filing requirements if they are living apart from their spouse and they're not filing a joint return because of domestic abuse. And abandoned spouses, which is someone who is married but lives apart from their spouse and can't locate their spouse after using due diligence. So due diligence is not really clearly defined, but if you have a phone number for the person, if you know where they live, if you're in contact with their family members, then I would say that due diligence probably means that you need to pursue those avenues to find out where the spouse is and to well, possibly to file together, but more likely it's just something that disqualifies you from this exception. And so in these cases, domestic abuse and abandoned spouses, again, when you get this simple question on the application, is Jane married? The answer can be no, even if they are married, because of these special exceptions. And the exceptions can only be used for a maximum of 3 consecutive years. So now that these exceptions have been in place for several years, we may start to see applicants who have used them for multiple years. So keep in mind that limitation.
So maybe we can stop there and take a few questions.
Yep, we have a few questions, and then we'll take questions again probably at the end of the presentation. A few of you guys had questions about special enrollment periods for a lot of these kind of employer type coverages, and so we're going to have an entire webinar on special enrollment periods early next year. But to answer a couple of these, someone asked, would COBRA, so this is a 2-part question, which I'll answer in just a second. So would COBRA running out trigger a special enrollment period? And the answer to that is yes. When you sort of use up the time period of COBRA and it expires, you do get a special enrollment period for that, regardless of when that happens during the year. And then part 2 of the question, if your employer is paying the premium for like the first couple of months of COBRA, and then they stop contributing to that, so then you have to pay the full cost, that also will trigger a special enrollment period for someone in that case. So those are 2 special enrollment periods. And then another special enrollment period question, we have sort of the listed of the limited benefit plans in Medicaid or CHIP that do not count as that don't bar you from eligibility for premium tax credits. And the question was, if you lose that type of plan, do you get a special enrollment period? And you do. That is new. So if you have one of those plans that only cover certain benefits like pregnancy, they only cover pregnancy services, and you lose that coverage, you do in fact get a special enrollment period for that. So those are our special enrollment period questions for right now, but I'll ask a few questions. So going back to the income question. So if you project being above 100% of the poverty line, but end up below, is there a limit on how your income, on how low your income can be to keep the premium tax credit and not have to repay it?
So I assume that we're talking about at the end of the tax year.
Yes.
Not an application. So at the end of the tax year, no. There's no bottom limit. So it's as long as you had been getting APTC, so the marketplace believed your income projection that you were going to have income above the poverty line. If you don't have income above the poverty line at the end of the year, there is no repayment. Or I'm sorry, you won't be disqualified. You won't be disqualified. That's a better way to put it, from the credit. And so it will work out to 0 repayment.
And then for going back to sort of our chart on comprehensive benefits for public coverage and non-comprehensive benefits, would someone who has CHIP perinatal coverage, where it only covers the pregnancy, would that be considered comprehensive coverage that would bar you from premium tax credit eligibility? And that one is no, as long as they only cover pregnancy related services, it is not comprehensive coverage. It has to be full Medicaid benefits for it to bar eligibility, is the general rule on that one. And then let's see. So we'll do one immigrant related question. We will have a immigrant eligibility webinar that we'll be presenting on October 4th that will go into all of these very complex rules. But someone had a question about if someone who is an immigrant meets all of the eligibility requirements except for they are 65 but not eligible for Medicare because they don't have the 40 quarters that you need to be eligible for premium-free Medicare, and so they have Medicare with a premium. So would that bar them from eligibility for premium tax credits?
Oh, no. So they would, as we said in the slide, if someone is not eligible for a premium-free Medicare, then they can instead get the voluntary Medicare where they have to pay for Part A. That's a case where, yes, it's a comprehensive benefit, but it isn't one that bars you from receiving premium tax credits. I hope that's the question we're answering.
Yes, exactly. It was a long question, but yes. And then going back to our family example of the family glitch, we had the family were not eligible for premium tax credits because the employee only offer was considered affordable. So would that family be eligible for Medicaid in that case?
Well, it depends on their income level, but there really isn't like a correlation between the two as far as what the employer cost is and whether that bars you from Medicaid. There are some little wrinkles there, but Medicaid eligibility will be determined by income, and in most cases without regard to an employer offer.
I will do a couple more now, and then we'll answer more at the end of the presentation. But for the head of household status, what if someone is married but has no dependent children? They meet all the other criteria. Would they be eligible for head of household?
Nope.
And then, yeah, that's an easy
No,
one.
sorry. I mean, it's, the head of household, you got to have a kid. You just, if you're married and you are not going to file with your spouse, you can't just be, I don't want to say single because it's a different filing status, but you can't just sort of be an independent person and call yourself head of household. You need a kid.
And then someone was clarifying that if someone is still legally married but hasn't seen their spouse, doesn't know who their spouse is in months or years, they've been abandoned, can they check no on that box where it asks, "Are you married?"
Yes, and actually we're going to talk a little bit more about this in the next webinar on household formation and income. So we'll go back through these slides in just a little more detail. But the answer is, if that person meets the criteria as an abandoned spouse, meaning that you have done due diligence in trying to find the spouse. So if you have their phone number, you have called their phone number to find them. If you've done due diligence, then yes, when you get that question that asks, "Are you married?" you can answer no.
Perfect. And then we have more questions, but we'll take those at the end of the presentation, and you can continue typing them in, and we'll log them, and we'll answer as many as we can at the end. So take it away.
Next, we're going to talk about the calculation of the premium tax credit. The premium tax credit is the difference between the cost of a benchmark plan and the expected premium contribution. And we're going to talk about what all of those things are. The benchmark plan is the second lowest cost silver plan that's available to each household member. So as you know, there are 4 different metal tiers in the marketplace: platinum, gold, silver, bronze. And for the purpose of determining the level of premium tax credit, we're going to look at the silver plan, which the one with an actuarial value of 70%, meaning the plan is expected to pay approximately 70% of the cost. As you go up the metal tier, there is, the costs paid by the plan are higher, but that also means that the premiums are higher. And in general, the cost sharing will be lower. The cost sharing will be higher if you choose, for instance, a bronze plan. So there's this balance that applicants have to face in choosing a plan, this balance between paying up front with premiums that may be higher or paying more at the point of service, so having higher cost sharing but lower premiums. There is also catastrophic coverage available. Catastrophic coverage is at a level less than bronze. It's a high deductible health plan that's available to individuals who are up to age 30, or people who are 30 and older who are granted a hardship exemption by the marketplace. And the premium tax credit doesn't apply to these plans. You can also note that we said hardship exemption, even though, as you know, the coverage mandate has been zeroed out for individuals. For the most part, that means that exemptions won't need to be used on the tax return, but they will still be available through the marketplace for cases like this. So people can get that hardship exemption and qualify for catastrophic coverage. And here you can see what the expected premium contribution line looks like. So at the bottom end of the scale, the income scale, people are paying 2% of their income toward premiums. And at the top, the maximum is 9.86%. And here's just a table that gives you some of those numbers and what that might mean in dollar terms. There are a number of factors that can affect the cost of a benchmark plan. One, the most obvious maybe, is age. Age can only cause no more than a 3-to-1 variation in cost, which means that let's say a 24-year-old is going to pay approximately a third of what a 64-year-old would pay. Also, each family member is rated separately. So we're going to look at the age of each family member individually and find their individual premium costs and then add them together. And when we add them together, then we'll get the total premium for the family. This is different than what people who are used to employer-sponsored coverage experience. So many people with employer-sponsored coverage, they'll have an option for the employee-only coverage, but then they'll often have a family option. And family coverage is usually with an employer. It doesn't matter whether you have 3 members in the family or 5 members in the family. It's the same price often. But in the marketplace, it's different because we're looking at the premium for each family member individually. Large families, families with more than 3 members who are under 21, we're only going to count the 3 oldest children. And another rating factor that's really important in the cost of a benchmark plan is geographic area. So someone who lives in an area that has very high health costs will have higher premiums, and those higher premiums will cause a higher premium tax credit. There are some other factors that affect premiums. Tobacco use is a big one in some areas. Tax applicants may pay up to 50% more if they are tobacco users. But it's important to note that this inflation of premiums is not accounted for in premium tax credit. So that's a cost that the applicant would need to bear, the enrollee would need to bear for themselves. And of course, the plan chosen by a consumer is going to affect the premium. The amount of premium tax credit is pegged to the benchmark plan. But then once that amount of premium tax credit is established, it can be applied to any other plan except a catastrophic plan. So you can, choose to take that amount and apply it to a bronze plan and pay less, or perhaps pay 0, or you can apply it to a gold plan or to some other silver plan. Let's look at this in terms of numbers and an example. We've got Teresa, Antonio, and their kids. They have a family income at approximately 200% of the poverty line. That makes their expected contribution 6.54% of income, and that's just based on the graph that we showed earlier. So that equals, about $3,200, $3,300 per year in premiums that they will be expected to contribute. So if we rate them individually and then sum the totals, we have 3 lowest cost silver plans that cover them all. And the lowest cost is $10,000 a year. We are looking at the benchmark for the second lowest cost, which is $10,542 a year. And that's the information that we need to come up with our premium tax credit calculation. We've got the cost of the benchmark plan minus the percentage or the percentage of income that they are expected to pay. And that leads to the amount of premium tax credit. And then once they have that $605 a month, they can go shopping with it within the marketplace and choose any plan they want. Now, let's say that the situation is a little different, and instead of all 4 members enrolling in a plan, the kids are eligible for CHIP. They enroll in CHIP. And so it's only Teresa and Antonio who are left to enroll in a marketplace because the kids are covered elsewhere. So you can see that their 3 lowest cost silver plans are going to cost less, obviously, because you've got 2 fewer people who are enrolling. So their benchmark plan now is only $610 a month. But what you'll notice is that their expected contribution has not changed. So they are still expected to pay 6.54% of income, even though it's 2 people enrolling instead of 4. And that's because the expected contribution is a percentage of income, and it doesn't matter how many people enroll. It's just a flat percentage of income. And so here, with a benchmark plan of $7,322 minus the expected contribution, in this case, they'll qualify for a premium tax credit that's just over $4,000 a year. And we can see the difference. This just charts the difference for us. The difference between having 4 people in the plan and having 2 people in the plan. You can see the same, but the total premium tax credit is lower in the second case. Now let's look at John. John, his benchmark plan is at $321 a month. So we've already established his benchmark plan. That makes his premium tax credit $189 a month. And if he were to earn a little bit more money, so going from 200% of the poverty line to 250%, then you can see that his expected contribution is going to go up. Instead of having to pay $132 a month, he would be expected to contribute $211 a month. So he is paying both a higher percentage of income, and he's paying that higher percentage on a larger income. And you can see the effect of that. He's bearing more of the cost of premiums on his own, and his monthly premium tax credit is smaller. Now let's look at the impact of age on the premium tax credit calculation. We've got the example we just saw of John with an income of at 200% of the poverty line, and he's getting a premium tax credit of $189 a month. But let's look at John Sr. John Sr. has a much higher benchmark cost. So his benchmark is almost $1,000 a month, and that's because of the age variation. This is the 3-to-1 age variation that I mentioned before. You can see it has a huge impact on his benchmark plan cost. But he is still making income that puts him at about 200% of the federal poverty line. So his contribution doesn't change, even though his premium costs are so much higher. He still only has, $24,000 of income, and so his income or his contribution is going to be the same as young John, but his premium tax credit is going to be much higher to meet the benchmark cost. And this is just an example of how the impact of your plan choice will on premiums. So, let's take young John again, and he has a premium tax credit of $189 a month. His premium that he pays out of pocket is going to fluctuate depending on what plan he chooses. So we establish that $180 a month using the benchmark plan calculation, but then he can go shopping with that amount. So he can get the silver plan benchmark that the cost was established by, or he can decide he wants the lowest cost silver plan and pay a little less. He could go to a bronze plan and pay a lot less. He could pay as little as $20 a month with this bronze plan. Or he could decide that he wants more coverage, more sort of financial protection and lower deductibles, and so he can get a gold plan, and he'll take that $189 of premium tax credit and go shopping for a gold plan that has a higher premium. There's one concept that is relatively new in the premium tax credit calculation. And it's important to think about, especially if you've been doing this for a couple of years and you're sort of used to how these premium costs work out. This is a wrinkle that you might want to keep in mind. So last year, reimbursements to insurance companies for the cost sharing reduction plans were terminated. Even though those reimbursements to insurance companies were terminated, the cost sharing reduction law is still in place. And so people who are eligible for CSRs can still get them. So of course, insurance companies were saying, well, how do we pay for that? We're giving these reductions, but we're not getting reimbursed for them. So of course, they decided that they needed to raise premiums. So there's this concept called silver loading. And in many states, they allowed insurers to load the costs onto silver level plans, knowing that a higher silver level plan cost would mean a higher premium tax credit. So people would be able to afford the higher silver loading because basically the premium tax credit was going to cover it. So silver plan premiums rose, and in many areas, the unsubsidized gold plan was comparable to the lowest cost silver plan. So the higher silver plan premiums were kind of an equalizer with gold plans in some cases. And so because the silver plan premiums rose, the premium tax credit also rose to cover the premium increases. And so in some cases, it really felt like people were held harmless from this silver loading due to silver loading because the premium tax credit rose. And even in states where insurers increased the premiums across the plans, not just the silver tier, the premium tax credit still rose. And in some cases, bronze plan premiums can be near zero because the premium tax credit is higher. It has more buying power essentially in the marketplace, and you can get a bronze plan for low or no cost. So let's look at how this would impact John. So John's premium tax credit is higher because of the higher benchmark cost. And so you can see what the effect is for John. If he takes the benchmark silver plan, he would be paying $132 a month in premiums because he has that higher premium tax credit amount. But he could take that premium tax credit amount of $250 a month, and he could buy other plans. He could buy the lowest cost silver plan. He could buy a bronze plan. And in that case, if he did get a bronze plan that has that low $200 total premium, his monthly premium tax credit would actually be capped at the value of the total premium. So he can't get money back from the premium tax credit, but he can get this bronze plan for no additional premium. It will be covered entirely by the monthly premium tax credit. Or he can get a gold plan. And notice here that the amount he would pay for a gold plan, $60 a month, is actually less than he would pay for either the benchmark silver plan or the lowest cost silver plan. So this is the kind of scenario that we're thinking of when we highlight this for you to take a closer look at premium costs, because you may be accustomed to seeing gold plan premiums that were much higher than silver, and silver being higher than bronze. And that's, that has been how the math has worked out in previous years. But because of the concept of silver loading, that might not always be the case. So definitely take a closer look at gold plans this year, and take a closer look at bronze plans for people who, really just want the security of insurance, but are not sure how much they're going to use and want to minimize their upfront costs.
So now we're going to spend just a few minutes on reconciliation of the premium tax credit. Now, yes, this is a tax issue. This is what tax preparers do. But I also know that a lot of assisters get questions because you have been the point of contact, you held their hand while they chose a plan, and now they're having trouble. And these enrollees want to come back to you and they want to know what happened. So let's talk about some of the things that might have happened. So one thing that we talked about a little bit is reconciliation. If a taxpayer receives excess advance payments of the premium tax credit, some or all of it is going to have to be paid back. There are repayment limits that apply to almost everyone except people with income over 400% of the poverty line and undocumented people. But everyone else is subject to a repayment limit. And so single people will pay back no more than $300 if they have income under 200% of the poverty line. People who are not filing a single will have a cap of double that amount. Again, I can't emphasize it enough. For people who are on the cusp of 400%, it's really important to talk to them about what full repayment means. There are some issues that occur on the 1095A that you might be asked to explain to a taxpayer who is confused about why their reconciliation didn't work out the way they thought it would. And one reason why it's important for you to think about some of these things is because a lot of tax preparers don't have a clue how some of these finer details work, because it involves a lot of understanding insurance. And unless you understand insurance, then it can be hard to understand these forms sometimes. So this is an excerpt from a 1095A that demonstrates someone's failure to pay their premium. So in this case, you would have a blank spot under monthly enrollment premium, and that indicates that the person didn't pay. But you have an amount under advance payment of the premium tax credit. So that means that the insurer got an APTC. So as you know, there's a 3-month grace period for non-payment. And if the taxpayer doesn't catch up on the missed premiums, coverage is terminated retroactively as of the end of the first month of non-payment. In this case, there are 2 things the taxpayer can do. The taxpayer can either pay back the APTC, via their reconciliation. So in this example, it would be pay back the $300 that the insurer got when the insured didn't pay the premium. Or the taxpayer can pay the premium for the month prior to the tax, pay the premium for that month, and they have to do it prior to the tax deadline. So in this case, the premium would be $100. So they could either repay $300 or pay the insurance company $100. So this might be a case where if someone has a high repayment amount, sometimes, perhaps a tax preparer hasn't really thought of some of these solutions, but you, as someone who knows insurance, may be a little more likely to understand that. And if you understand the grace period rules, you'll know that if there are multiple months of APTC without a premium, column A, then this is probably an error. And so this might be a case where you want to do some digging with healthcare.gov. You want to look into the 1095A and make sure it's correct. Another anomaly that you can see on the 1095A is a blank spot for the second lowest cost silver plan. So if that amount is blank, the person likely did not get APTC for marketplace insurance in those months. And so you can see that's the case in this little excerpt here. There's no APTC amount. If that second column is just wrong, then it's likely that there is some kind of change in circumstance that wasn't reported to the marketplace. Maybe family size changed, or a dependent dropped off, something like that. So if you want to determine the correct tax credit amount, you have to basically look and figure out, was this person eligible for that month, and then add the correct second lowest cost silver plan through the marketplace tax lookup tool. This isn't something that they're going to give you an amended 1095A for. One thing that, it may be obvious, but I'll say it anyway, is that if you are adding in that second lowest cost silver plan, don't also add in the APTC, because they didn't get an APTC. So I'll tell you, tax software, if they get this result, or if people just input this form as it is, then the person is not going to get a premium tax credit for April or May. But they might be entitled to a premium tax credit for April or May. And the way that you make in software, the way that you make them entitled, is going to be entering that second lowest cost silver plan. There's also a reconciliation issue that deals with overlapping coverage, and these rules get really complex and detailed. This is just a little overview. In general, to be eligible for PTC, as we said, the taxpayer must not be eligible for or enrolled in other minimum essential coverage, but there are exceptions. So one is the first day rule. People who are eligible for premium tax credits on the first day of the month are considered eligible for the full month. So even if they get an employer, new employer sponsored coverage or something, they can still be eligible for premium tax credits in that month. For Medicaid, if a person is enrolled and is getting APTC, but's later determined eligible for Medicaid, they can get PTC for those retroactive Medicaid months, not have to pay it back. And the person is generally considered eligible for PTC for the entire calendar year. Why? Because they had been determined ineligible for Medicaid at the start of the year. That's how they got into the PTC world to begin with. Data matching might pick those people up, and you'd be encouraged to drop the marketplace coverage for Medicaid. But there is sort of a general rule about that. And Medicare, a person loses eligibility for PTC when they become Medicare eligible, even if they don't enroll. So people shouldn't push off their Medicare enrollment because they're in the marketplace and like their plan. That's not a good idea. The loss of eligibility occurs on the first day of the fourth full month after the person becomes eligible for Medicare. So there's a pretty big lip there. And finally, with employer-sponsored coverage, if a taxpayer accurately tells the marketplace the cost of their employer-sponsored coverage, and despite telling them that, they still are awarded APTC, and we've seen this, then the taxpayer could claim PTC. So basically, they're held harmless if there's like a marketplace screw up. And we have some resources that Hallie mentioned before. Hallie puts together great reference guides and charts, and I refer to them all the time. And then we have some longer pieces that have some commonly asked questions and key facts.
Perfect, thank you. And we're running short on time, but we'll do a couple questions now. And then if your question is not answered or you have a follow-up question, please feel free to email us. You can use that general inquiries email, or you can email myself or Tara, and we'll get an answer to you as soon as we can. Just as a reminder too, I know this is a lot of information, and this is the start of many webinars for going into open enrollment. So we will have webinars on next week. We have one on determining income and households. So that answers some of these. We'll go into more detail about some of these trickier, how you decide who is in a household and who is not, and whose income to count. And then, as I mentioned, we're also going to have a plan design webinar, a plan selection strategies webinar, a webinar on the auto renewal process, and then we'll also have webinars on immigrant eligibility, which will go into a lot of detail on those very complex rules, and that will be October 4th. And then we will also have a webinar on data matching issues. So some of you had questions about how you prove your income if it's variable, how you should input it and into the application in the first place. And so we'll go into a lot of detail in how to do that in that webinar. And that webinar is going to be October 11th. And we will send all of this information to you guys, and it is on the website, so you don't have to remember all of it. We'll send it out in follow-up emails, so you'll be notified. And then, so we'll take a couple of questions, and I'm sorry we can't answer all of your questions. If a taxpayer doesn't have any income, do they have to file a federal income tax to reconcile if they received a premium tax credit?
Yes, absolutely. If you received a premium tax credit, you need to file a tax return, even if you have no other reason to do it.
And then for those affordability threshold numbers that we showed, are those established annually? Are they, and who are they released by, and where can people kind of find them?
Those numbers they change annually. It's some kind of measure of GDP or something. So those are announced by Treasury.
Perfect. And then we had a question about answering the if someone has an offer of COBRA coverage and they have an offer but they don't plan to take it, how they sort of note that on the application. And it's a little confusing, so I'm looking at the screenshot of how the answers go. So I'll try to answer this verbally, and Tara, please jump in if this doesn't make sense. But essentially, how the questions, at least in healthcare.gov, are asked. It will ask you at the beginning, when you first are asked, do you have an offer of coverage, even if it is COBRA, and you answer yes, and then it will ask if you are currently enrolled in the coverage, and that is where you would say no if you're not planning on enrolling in COBRA. And then it will ask you if you are currently in a waiting or probationary period, and you would say no. And then it asks you, are you a current or former employee of this employer? And that's where you would say yes, and you will be able to choose a little drop down that says no longer working for this employer. And then it will finally ask, is this coverage from COBRA? So, and that's where you say yes. And so it's a little buried in the application, but that's how you essentially get to the COBRA question. So the application knows that this offer of coverage is COBRA, and so it does not bar eligibility if you're not enrolled. So that's the long answer to that question. And then one moment. Will a family be able to apply for a catastrophic health plan if the employee insurance for the family is unaffordable? So they're essentially barred from eligibility for a tax credit because the offer of coverage is considered affordable, but their family offer is unaffordable. So they're in the family glitch. Would they be able to apply for catastrophic insurance in that case?
Yes. And I don't know Hallie, do you know the percentage off the top of your head? It's 8% something.
Yeah, it's 8.05, I want to say, for this
Is that
year.
for next year though?
Oh, for next year, no. For next year, it's a little higher. One moment.
Yeah,
Let me
okay.
check my reference
Okay,
guide.
so the definition of affordability is different for getting a PTC versus qualifying for an exemption. And it's lower to qualify for an exemption. So if your insurance cost exceeds whatever it is, 8.05 or whatever percentage that is, exceeds that amount but is considered affordable by the marketplace, you may still get an exemption, even though the marketplace would say that you have an affordable offer of coverage. So in that case, I would say that they apply for an exemption based on affordability. They'll look at the cost of employer-sponsored coverage. The other huge difference with the exemption is that instead of just looking at the cost of coverage for the employee, they'll also look at the cost of family coverage, like family coverage outright. So if your family coverage costs $1,000 a month, then they will measure affordability by $1,000 a month for the family members. So it is definitely a case where people can get that exemption under these criteria, but then they can use that exemption to go into the market to buy catastrophic coverage if that's what they want to do.
And then we'll do one more really quick question. A lot of your questions are really good and very complicated. So if we have not answered your question, please email it to us and we will answer it via email or over the phone, however is easiest. But someone just had a question about where we get the benchmark plan number for our examples. And essentially the benchmark plan is dependent on where you live. So it is whatever the second lowest cost, the second lowest cost silver plan in your area. So it completely depends on where you live. And it will be, it will change depending on what zip code and area you're in. But essentially whatever plan is the second lowest cost silver plan is going to be that benchmark plan. And that will be the plan that is used to determine the premium tax credit amount for people in your area. So that's
and it'll vary not just by geography, but by age, which is
yes,
a huge variable, and by the number of people you have in the plan.
Yes.
So by your family size.
Exactly. And so again, thank you so much for joining us today. Again, you guys have great questions, so keep them coming. A couple of words just in closing. As a reminder, we're going to be distributing both the slides and a video recording of this webinar, and we'll also include those resources that we had on that slide. We'll have links to all of those resources for you guys. Part 2 of this webinar is scheduled for next Tuesday, September 18th at 2 p.m. Eastern, 11 a.m. Pacific, and that's going to go over how to determine household size and income. And then part 3 is scheduled for next Thursday, September 20th at 2 p.m. Eastern, 11 a.m. Pacific, and that's going to go over plan design. And then we'll have 2 more webinars the following week. So we'll keep them coming, and you guys can register for those webinars and our other webinars at the Beyond the Basics website under upcoming webinars. And you can also email me and I can send you the registration form as well. So please go to that website. We have all sorts of updated reference charts, guides, frequently asked questions, all of that. So, and if you have suggestions about resources that we don't have that you would like to see, please let us know. Please email us. And again, if you run into any questions, need assistance going forward, please email our Beyond the Basics contact email, or you can email me at cloud@cbpp.org. So with that, we'll bring this to a close, and thank you again so much for joining us today, and hopefully we'll see you next week. Thank you.